Welcome to the Deep Dive. We're the place where we take the information you're curious about and really try to get to the heart of what mattered.
Exactly. Boiling it down.
Yeah. And you, our listener, pointed us towards a really fascinating book. It's called The End of Accounting and the Path Forward for Investors and Managers
Right, by Baruch Lev and Feng Gu, published back in 2016.
by Wiley Finance, part of John Wiley and Sons, which, interestingly, goes all the way back to 1807. Oldest independent U.S. publisher, I think.
Wow, yeah, long history there. But Lev and Gu, they're really, experts in this field.
Absolutely. And they tackle something pretty fundamental. Is traditional financial accounting still, well, relevant? Especially for investors and managers today.
That's the core question. How useful is it really in today's economy?
So you wanted us to explore it, and that's our mission for this deep dive. Unpack their main arguments, see what they mean for, how you might understand a business or think about investments.
And they don't pull any punches right from the start, do they?
Not at all. They kick off with this pretty startling claim that traditional financial reports, they give you maybe only a trifling 5% of the information investors actually need.
5%, that's
Yeah.
tiny. It makes you stop and think.
It really does. Okay, so let's get into how they build that case.
Well, a key part of their argument is this idea of a fast and continuous deterioration in how useful financial info has been.
Over the last 50 years or so.
Yeah, over the last half century. And they actually say it's sped up, gotten worse in the last couple of decades.
Which is kind of counterintuitive, isn't it? Because you think about all the regulations, Sarbanes-Oxley, all the efforts to improve transparency.
Exactly. Regulators have been trying, pushing for better accounting, more disclosure. But Lev and Ghosn are basically saying it hasn't worked. Or at least it hasn't kept pace with how fundamentally business has changed.
So it's like polishing the chrome on a car when the engine itself is becoming obsolete.
And that's a good way to put it. They use this analogy of Consumer Reports evaluation for financial reports.
And it fails.
It's an unsatisfactory report, yeah. A big thumbs down. Their central point is that the numbers just don't reflect what actually creates corporate value anymore.
Yeah.
The things that give a company a real sustainable edge.
Right. It's not capturing the secret sauce.
Not really. And they cite research like a 2013 study suggesting that less transparency actually increases a company's cost of capital. So there are real bottom line consequences.
Uh-huh. It's not just academic. And it's interesting, they note that even with minor differences, like how some European countries might treat R&D.
Under IFRS, yeah, they might capitalize some R&D.
Right. But despite those small variations, the basic accounting structure is pretty much the same everywhere in free markets.
That uniformity makes the lack of change even more, well, stark. They use this really effective analogy. Imagine getting a medical checkup report today that looks exactly like one from 110 years ago.
Ugh. Yeah, you wouldn't feel too confident about that checkup, would you?
Probably not. And they actually did something similar. They looked at U.S. Steel's financial reports from 1902 and 2012.
A whole century apart. And what did they find?
Amazingly similar. The basic layout of the income statement sales, cost of sales, taxes, that stuff, and the balance sheet assets, liabilities, equity. Fundamentally, the structure was identical.
Wow. So investors in 2012 were getting pretty much the same type of information as investors in 1902.
Largely, yes. Even though the tools and analytical capabilities investors have now are, light years ahead.
That's incredible. Were there any major differences?
The main one they flagged on the balance sheet was goodwill and intangibles showing up in 2012.
From mergers and acquisitions, presumably.
Exactly. Which, they note, was different from the original founders' focus, which seemed more on organic growth, building it themselves.
Interesting side note.
And another little detail, U.S. Steel actually provided a cash flow statement back in 1902, voluntarily, even though it wasn't required then.
Huh. Ahead of the curve in some ways, but stuck in others. So the core statements didn't change much. But what about the fine print, the footnotes?
That's where things exploded. In 1902, just a few footnotes.
In 2012?
54 pages of them.
54 pages. Good grief.
Yeah. And Lev and Gu point out, it's a mixed bag. Some of it is just like boilerplate restating basic accounting principles you'd learn in Accounting 101.
Okay.
But a lot of it is based on managerial estimates, judgment calls by the company.
So way more volume of information, but maybe not proportionally more clarity or usefulness.
That seems to be their argument. More bulk, but the fundamental picture hasn't necessarily gotten sharper and might even be fuzzier because of all the estimates.
Okay, so this leads to the obvious question. If it's not working so well, why hasn't accounting changed more? Why hasn't it improved?
They tackle that directly in a devil's advocate section, and they bring up the QWERTY keyboard.
Ah, the classic example of good enough sticking around even if something better exists.
Exactly. It's not the most efficient layout, but it's what everyone learned. It's embedded in everything, so changing it is just massively difficult. The switching costs are too high.
So the idea is maybe financial reporting just got locked in decades ago.
That's the analogy, yeah. Maybe it reached a certain stage of development, and despite obvious needs for an update, the inertia of the system is just too strong.
But they also argue that good ideas have been proposed, right? They just didn't get adopted.
Right. They highlight Yuji Ijiri's idea from way back in 1989, triple entry bookkeeping.
Triple entry. So balance sheet, income statement, and what's the third?
A report on the momentum of operations, basically tracking the rate of change in things like sales, expenses, earnings.
Momentum. So not just where you are, but how fast you're accelerating or decelerating.
Precisely. Think about it. Knowing if sales growth is speeding up or slowing down could be incredibly useful for forecasting, couldn't it?
Yeah, absolutely. Way more predictive than just a static snapshot.
That was the potential. But despite Ijiri laying it all out, the idea just fizzled. It never gained traction with the standard setters.
A missed opportunity, perhaps. Okay, let's pivot slightly to earnings. The bottom line, everyone focuses on earnings, right?
Traditionally, yes. Lev and Gu look at the two main ways people use them: forecasting future performance and judging current performance based on earnings surprises.
You know, whether a company beats or misses analysts' expectations.
Exactly. And their findings here are also pretty challenging to the status quo.
How so?
Well, first, the point to evidence that cash flows actual cash moving in and out have actually become better predictors of investment returns than reported earnings.
So cash is king, even more so than earnings now.
It seems that way, according to their analysis. It kind of undermines the primacy of the earnings number.
Okay, and what about those earnings surprises? Beating or missing the estimates?
This is really interesting. They looked at data from 2011 to 2013 for the biggest 1,000 companies, and they found that the stock price reaction to missing or beating earnings was surprisingly small.
Really? Even a big miss didn't tank the stock too much.
Often, no. And even beating expectations didn't always lead to a big pop. It suggests that maybe investors are becoming a bit skeptical about what those reported earnings surprises actually signify about the real underlying business.
Maybe they see them as too easily managed or not reflective of long-term value.
That could be part of it. They do note that historically these surprises used to matter more. The impact was bigger in the past, which again points to this idea that earnings might be losing their information content over time.
And didn't they also find something about analysts' predictions?
Yes. They included a chart showing that for most years between 2000 and 2013, analysts were actually more accurate at predicting cash flows than they were at predicting earnings.
Wow. So the pros are better at forecasting cash too. It all seems to point away from earnings being the be-all and end-all.
That's definitely the direction their evidence leads.
So if traditional accounting, especially earnings, is becoming less relevant, what's driving this change? What's the root cause, according to Lev and Go?
A huge factor they identify is the rise of intangible assets. This really took off from the 1980s onwards.
Intangibles. Okay, so we're talking patents, brands, software, IT systems, even human capital, right? The workforce's skills.
Exactly. All that stuff is incredibly valuable, but doesn't necessarily have a physical form. And here's the rub. Standard accounting often treats spending on these things, R&D, brand building, software development, as just regular expenses for the period.
Not as investments that build an asset on the balance sheet.
Right. So you spend $1 billion developing groundbreaking software, and accounting might just see it as $1 billion expense hitting the income statement that year.
Which makes the company look less profitable in the short term.
And understates the company's assets and equity on the balance sheet.
Yeah.
It distorts both key statements.
They mentioned Alan Greenspan calling these conceptual industries, didn't they?
Yeah, like software, biotech, internet services, industries where almost all the value is tied up in these intangibles.
So the argument is that the main things that create value for many, maybe most, businesses today are things accounting just doesn't handle well.
That's a central pillar of their thesis. The value drivers shifted, but accounting rules largely didn't keep up.
Okay, so intangibles are one big issue. What else?
Another major one is the growing reliance on accounting estimates, managerial judgment calls.
We touched on that with the footnotes, but it's a broader problem.
Oh, yeah. GAAP, the accounting rules in the U.S. increasingly requires companies to estimate things. Think about bad debts, warranty costs, pension obligations, asset impairments, fair value adjustments.
Lots of places where managers have to make a calculated guess.
Exactly. And some items, like accounting for employee stock options, involve like multiple layers of estimates on top of estimates. It gets complex.
And they found evidence this is increasing.
Yes, they show data looking at the frequency of words like estimate, assess, judgment in financial reports. It's been climbing.
Okay, but does it matter? So what if there are more estimates?
Well, here's what's concerning. They found a negative correlation between how often these estimate terms appear and the company's subsequent stock returns.
Whoa, wait. So more estimates mentioned tends to mean worse future stock performance.
That's what their data suggested.
Mm-hmm.
It implies that investors might not be fully appreciating how vulnerable or perhaps subjective this estimation-based information is.
Until it's too late, maybe?
Perhaps. They also showed that predicting future profitability, specifically return on equity or ROE, is harder rationed. The prediction errors are bigger for companies that use a lot of estimates.
So more estimates equals less reliable earnings.
It points strongly in that direction. Less useful for predicting the future.
Okay, so accounting struggles with intangibles, and it's relying more on potentially shaky estimates. What else are they critical of?
They talk about what they call sins of omission and sins of commission.
Okay, sins of omission, what's being left out?
These are important business events that happen, but they aren't immediate financial transactions, so accounting doesn't pick them up right away.
Like what?
Think about a drug company getting great results in a clinical trial, or a tech company signing a massive new client, or losing one, or a key competitor launching a disruptive product, or even losing a star CEO or scientist.
Right, huge news for the company's future, but no debit or credit gets recorded immediately.
Exactly. These are often non-transactional, but incredibly significant. And this is where things like those other SEC filings, the Form 8K, come in.
The 8K reports significant events more quickly.
Generally, yes. They're meant for disclosing material events between the regular quarterly reports. Lev and Gu found that both the number of 8K filings and the stock market's reaction to them have been increasing over time.
Suggesting investors are finding valuable, timely information there that's not in the standard financials yet?
That's the implication. And it ties back to earnings usefulness, too. They found that companies filing lots of 8Ks, their reported earnings are generally poorer predictors of their future earnings.
Interesting. So lots of significant non-transactional stuff happening makes the traditional accounting numbers less reliable for forecasting.
It seems so. The accounting lags behind the business reality captured in those more frequent disclosures.
Okay, that covers sins of omission. What about sins of commission? What is accounting doing wrong?
Here, they mean situations where following the accounting rules actually creates a misleading picture. Their main example is restructuring costs.
Like when a company announces layoffs or plant closures, usually involves big charges against earnings.
Right. But what often happens, the company announces this big restructuring charge, earnings take a hit, but the stock price goes up.
Yeah, that always seems backwards. Why does that happen?
They explain it using the accounting principle of conservatism. Basically, accountants are supposed to recognize losses or costs as soon as they're likely, but only recognize gains or benefits when they're pretty much certain.
Okay.
So with restructuring, the costs are recognized up front, dragging down reported earnings. But the expected benefits like becoming leaner, more efficient, more profitable in the future, those aren't recognized in the accounting until they actually materialize.
So the market is looking ahead to the benefits, while the accounting is only showing the immediate pain.
Exactly. It creates this disconnect between the earnings number and the market's assessment of the company's value and prospects. That's a sin of commission. Following the rules leads to a potentially misleading signal.
Got it. So given all these issues, intangibles, estimates, omissions, commissions, where do Lev and Gu suggest investors and managers should focus instead?
They argue the real key is to focus on a company's strategic assets and how effectively management deploys them.
Strategic assets.
Yeah.
What defines those?
Things that are valuable, rare, and hard for competitors to imitate. The real sources of sustainable competitive advantage.
So beyond just looking at the factory or the inventory?
Oh yeah, it could be a powerful brand franchise, unique patents, exceptional talent pool, maybe crucial customer relationships, or even things like oil and gas reserves for energy companies. It varies by industry.
And it's not just having these assets, right? It's about using them.
Absolutely. That's the crucial part. Deployment. How well does management leverage these strategic assets to actually create value? That's what drives long-term success, they argue, much more than just looking at historical revenues and earnings, which are really just outcomes.
So shift the focus from the financial results to the underlying drivers of those results.
Precisely. And to help do that, they actually propose a new kind of report.
Oh, what's that?
They call it a Strategic Resources and Consequences Report. The idea is to explicitly identify these key strategic assets and report on how they're being managed and what results that management is producing.
A completely different lens compared to a traditional income statement or balance sheet.
A very different lens, yes. Focused on the strategic inputs and their effectiveness, not just the financial outputs.
Okay, so let's try and wrap this up. This deep dive into the end of accounting. It really presents a powerful challenge, doesn't it?
It absolutely does. The core message is that maybe we need a fundamental rethink about the corporate information investors and managers rely on.
Moving beyond just the traditional accounting numbers, which, according to Lev and Gu, are potentially outdated, maybe even misleading in some cases.
Yeah, flawed, at least in terms of reflecting what truly drives modern business value and future prospects.
So for you, our listener, always learning, always trying to understand things better, this provides a framework, really, a way to question the traditional approach.
It encourages a more critical eye towards standard financial analysis, definitely. Ask tougher questions.
And maybe think about where else to look for insights. So here's a final thought to maybe chew on. Considering everything we've discussed from the end of accounting, how might you start to reevaluate the sources you use when you're trying to figure out how healthy a business really is or where it's headed?
Yeah, what weight do you give the traditional financials versus, well, other things? Like understanding those strategic assets they talk about.
Right. Maybe even try to imagine what that strategic resources and consequences report would look like for a company you know well. What are its key assets? How are they being used?
It's a different way of thinking for sure. Definitely something to ponder long after this deep dive ends.